Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
U.S. shoppers spent $14.2 billion during a Prime Day. I was not one of them, but that's up 11% from a year ago, as Lisa was reporting. So pretty solid results there. You got to like that if you're an Amazon follower. Poonam Goyal, she is an Amazon follower. Senior U.S. equity, e-commerce, and retail analyst for Bloomberg Intelligence, joining us from Princeton, New Jersey via Zoom. Poonam, the numbers Lisa was just reporting, $14.2 billion, 11% growth year over year. That seems pretty good to me. What do you think?
Yeah, the numbers are great. They continue to show that shoppers are focused on sales and they're seeking value. And when Amazon and others have events such as these, they do drive traffic and conversion onto the platforms. So really good numbers, likely some pull forward in spend. So you will probably see things taper off a little bit after the Prime Day sales event, but nonetheless, a very strong start, it seems, to 3Q for Amazon.
Yeah, I was just looking at eMarketer, which I know is an independent group that kind of looks at this stuff. They were expecting U.S. shoppers to spend $8.2 billion on Amazon during the event. So I guess better than expected is the way to think about it.
Yes, I mean, the numbers are a little different because the numbers that Adobe reported are not just on Amazon, they're total online sales.
Gotcha, okay.
But nonetheless, very strong results, and they are better than Adobe's initial estimates for a 10.5% increase.
Average household spend $152 on Amazon on Prime Day. That sounds like a good number as well. How does that stack up?
It's a good number. We expected Amazon shoppers to shop less this year on Prime Day than last year, according to our own survey that we ran ahead of Prime Day. So not surprised there, as shoppers are crunched for cash and they are trying to be picky and choosy on where they spend and what they spend, shopping really on the lists that they had going into Prime Day. So we're seeing a little bit of that. But overall, more shoppers joined Prime Day this year, reported by Amazon, which proves to be even more encouraging because, when you see that, that trend hopefully holds up and drives more shopping on the platform, even after Prime Day.
You see numbers like the Amazon Prime Day number, the 11% growth year over year. It seems like a really strong number. We had retail sales earlier in the week, came in better than expected. I know the consumer's hurting out there. I know inflation's hitting a lot of folks really hard, but it doesn't seem like we're seeing it in the spending. How do you guys think about it? What do you hear from the companies that you cover?
Yeah, I think it depends on the retailers that you're looking at. I do think that, we've talked about this in the past where the value customer is trading down. We've seen that in the results earlier this year at Walmart, where numbers are strong because they are driving in more customers into their doors and online. And then the middle, the department stores, they continue to get squeezed to the large extent. And I think that trend will continue. So I do think that where there's the right product, the right price, customers are going there. They're still going to experiences. They're going for convenience, which is where Amazon plays a big role. But they are being picky and choosy, and there will be some bifurcation when they report between the numbers, because not everyone will do well, as we're hearing and seeing in these numbers.
It's only mid-July, but I guess people with kids have to start thinking about back to school. My guys are all out of that stage, thankfully. What's the back-to-school season look like this year? What are the expectations?
Yeah, the expectations are for back-to-school season sales to grow, and Prime Day is going to help with that. This year's Prime Day event came a little later in the season, which means that more back-to-school shopping likely occurred, dorm shopping, et cetera, on the Prime Day sales event. That said, you will see people buy backpacks, you will see them buy supplies, you will see them shop for dorm room stuff and apparel. But at the same time, where are they shopping for that? I think the retailers that are going to drive that spend are continuing to be the same. It's going to be the Amazons, it's going to be the Walmarts, the Targets, where they can get the value that they're looking for.
So what is the expectation for the holiday season this year? Are you guys forecasting growth in holiday spending? Because I know that's the big season for retailers.
We are expecting growth this holiday season, but I do think there are challenges as we enter this holiday season. Keep in mind that the retail calendar is different this year, so it is a tougher calendar comparison. Last year was very, very strong. Last year had some extra selling days. So the calendar shakes up as being a headwind and going into the holiday season. That said, with elections and just so many other things happening this year, we do think the consumer is going to be a little diverted. So retailers will have to work harder to capture their spend. And it will be a tougher holiday season, but we do see some growth still this year.
What are we seeing just in that dynamic, Poonam, of the bricks and mortar versus e-commerce? Because we had gone through, I'm going to say, almost a generation of downsizing retail footprint in the United States. And I kind of got the sense that during the pandemic, that kind of slowed, if not reversed a little bit. Where are we on that dynamic between I need to own some brick and mortar versus, I can kind of go lean more heavily on retail, e-tail?
Sure. So I think, we'll always need brick and mortar stores. I don't think they go away, but we've talked about this before. I do think we need some balance, and we're still continuing to push forward on that balance. There will be more consolidation in retail. I think it's necessary because we still are overstored, but at the same time, we have retailers coming in from abroad that are expanding, whether it's the Primarks, once again, a value play, or whether it's the Aldis and some of the grocers. We are seeing them take space as they encroach on the U.S. landscape. That said, our estimates call for retail sales growing to a third, e-tail sales growing to a third of total retail sales, up from 25% last year. So still high single digit, double digit growth in the online landscape for the next 5 to 7 years, which means that people will be shopping less at brick and mortars and more online. And we saw that trend come back. Right after the pandemic, you saw this rush to stores because people wanted the experience of seeing things, touching things, being out there. But now they've normalized again, and we are seeing the shift back to shopping more online.
All right. Interesting stuff. Poonam Goyal, thank you so much for joining us. Poonam Goyal, Senior U.S. e-commerce and retail analyst, Bloomberg Intelligence, joining us via Zoom from Princeton.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk to some earnings here. We had a big earnings play coming out of the financial services. Blackstone profit. Blackstone, just huge asset manager. It's just amazing how big they've become on global Wall Street. But their profit missed estimates as real estate exits slow. Let's bring in Paul Goldberg. He follows that part of the financial services sector for us. Paul, Blackstone, it doesn't get any bigger, more influential from an asset management perspective than our friends at Blackstone. Talk to us about the quarter they just reported.
Hi, Paul. Thank you for having me. The quarter was more or less as expected. You did mention they missed by a few pennies, but a lot of the profitability depends on realization activity, which was slow. And it wasn't just the real estate. It was kind of on the slower end across the segments and the strategies that they cover. So it's not, I don't think it's surprising. And what we saw is what we kind of see in the headlines. The private equity is improving, but slowly. Real estate's still kind of dragging its feet, and the private credit is being very strong. So the profitability that they showed was very much along those lines.
What are they saying about the real commercial real estate business? Because when I think about that business, I think about the Blackstones of the world. I think about Morgan Stanley. They've always been big investors in real estate. What are the smart people telling you about that part of the market?
The smart people at Blackstone said we got out of that market.
So
not completely. So there's still a few percentage of the portfolio in the U.S. real estate, and they still mention that it's pretty painful. And globally, there is some commercial real estate that they're in, but 3/4 of the real estate portfolio is in multifamily, logistic, data centers, where they're pushing with their AI. It's a very different composition. Can you see idiosyncratic pains, something going out of line? Yes, absolutely. But in terms of the future growth, I think they're positioned quite differently from what we've kind of seen from the banks.
And Blackstone is up about 3.5% today, the stock at a 52-week high. What are they saying about deal activity here? Because I know, Paul, the M&A market, the IPO market, Last couple of years has been pretty slow. So it's tough for the Blackstones of the world to kind of realize and get some liquidity on their investments. What are they saying about that?
Yeah, so some green shoots there, some improvement in the second quarter, although obviously not material enough to lift the earnings, but they're seeing things getting better into the second half. And most of it, and they kind of mentioned it 3 months ago on the earnings call, we'll probably have to wait till the end of the year and go into the 25 for a material improvement. And that's what you kind of seen in the consensus reflected, that people do see a significant lift. And in terms of activity, they deployed $34 billion. They had almost $40 billion of inflows during the quarter. So the activity is improving. It's not at the 2021 levels, and it will take some time to get back there, but it's better.
Hey, Paul, when you think Blackstone, you think Steven Schwartzman, the chairman, the CEO, the co-founder, one of the all-time greats, the giants in private equity. He's 77 years old, and I know Jonathan Gray there is the president COO, and he's 54. What is the succession plan there at Blackstone?
You did mention the two figures, and it kind of looks pretty straight at the moment, unless things change. But Jonathan Gray has been doing a great job, and Schwartzman is not planning to step away, as we're seeing at the moment. But there's a line of succession that's clearly there.
Paul, is Blackstone in a capital raise mode now? Where are they in terms of their capital?
I think with $1.1 trillion of assets under management and different buckets that I discussed earlier, they constantly in the fundraising mode. So the big areas where they're fundraising in infrastructure, they're fundraising, and mentioned data centers, then fundraising in wealth strategies. They have already $240 billion of assets that in different wealth strategies. Early in the year, last year, we had some issues where you saw some outflows from wealth strategies. They're all positive this quarter. So those are good things. And then they talked about the big flagship funds. They're raising more of them in the second half, and even more coming back in 2025, which helps their fees.
Yep, absolutely. All right, Paul, thanks very much. Appreciate it. As always, Paul Goldberg, he's a senior equity analyst, Bloomberg Intelligence. He covers a lot of those asset managers, the KKRs, the Blackstones of the world. He also covers the Canadian banks. So he does it all for Bloomberg Intelligence. He's down in Princeton.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Matt Miller sitting in for Alex Steele here today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well here. We had a raft of economic data recently, including today we had the initial jobless claims. Came in a little bit higher than expected, but I don't know. The question I think is, has this Federal Reserve already gotten us a soft landing? I don't know. It feels like it. We'll check in with a professional who does this stuff for a living. Joe Brusuelis joins us in studio. How good is that? So he gets a gold star. He's the chief economist over at RSM. Joe, how's our Fed done here in landing this economy?
Okay, so when we look back on this in a number of years, we're going to think the Fed did an extraordinary thing, a real policy achievement in bringing the U.S. economy in for a soft landing after hiking the federal funds rate by 550 basis points. If the Fed was truly data dependent, we wouldn't be waiting for a September cut. They'd be cutting now. As a matter of fact, if you're all out there, look at the TAYL on your Bloomberg terminal.
The Taylor rule. I love that function, actually.
You can estimate the Fed's reaction function using 4% as a non-accelerating rate of inflation and unemployment. That's the Fed's estimate. And I would suggest a neutral rate of 1.1. You get an optimal rate of 3.9%, which implies the Fed's policy rate, people, is way too tight.
Why do you choose a neutral rate of 1.1? Isn't it higher?
No, I think it's actually, the Fed, John Williams thinks it's 0.5. No, I'm double that. And it indeed may be higher. That's something that's unobservable. We do our best to make that estimate, Matt. But I think that that's appropriate given where the economy is and the structural changes that we're going through. Because I think we're all pretty much here in Wall Street in agreement that rates are going to be higher for longer because inflation is not going to be what it was for the 20 years prior to the pandemic. It's just not, due to the distortions around movement of supply chains back to friendly countries and the geopolitical tensions that are going to cause problems no matter who's in the White House.
Now, if we get a Trump presidency, I'm fascinated by some of his proposals, because the whole premise of the Republican Party is that Biden caused this inflation and Bidenflation is bad and they're going to stop inflation, right? But Trump wants to cut taxes. I'm happy about that.
Yes, I know you are.
I'm not fighting against that. But he wants to basically give us a ton of cash. Plus, he wants to put tariffs on everything. That's inflationary, right? Those two things are inflationary. And he wants to stop immigration and deport all of the illegal immigrants that are already here. So that would tighten the labor pool. That's inflationary. Seems like everything he wants to do is inflationary. Is he just not going to follow through on this stuff?
No, actually, after the 4 years of Trump, I actually take him at his word literally. That's what he intends to do. Right, so if you look at expectations on Wall Street, matter of fact, look at the WIRP screen, Fed funds probabilities. The market's pricing in 100 basis points of cuts over the next 5 meetings. Okay, if Donald Trump is elected, that's a big if, and if he
it's not a very big if.
Well, I don't want to go there.
The odds are strong.
Yeah, I agree, and I see that, and we're all adjusting our base case for 2025 as we speak. But if he gets in, and if he follows through on this, unemployment rate's going to fall. Wage prices are going to go up. The Fed's going to be worried about a wage price spiral, right? Then the Fed will reverse course and begin hiking rates. And there's where we get into what I think is the single biggest economic and financial risk of a potentially second Trump administration, the independence of the central bank. I'm not talking about personalities. Whether Powell is fired, stays, goes is immaterial. It's the instrumental independence of the Fed that's at risk.
I'm glad you mentioned that. Jason Furman, who was the head of the National Economic Council for Obama, right?
Yep.
He tweeted out that he has selected recently announced policies and ranked them in terms of how consequentially bad they would be. Number 1 is the 10% across the board tariffs. This is Furman's opinion, not mine. Number 2 is the $4.5 trillion of tax cuts. Number 3 is threatening independence of the Fed. I would have thought that'd be a little bit higher. Number 4 is permanent tax-free tips. I don't see why that matters. Nobody ever claims tips anyway. And then number 5 is the 5% cap on rent increases that Biden has floated.
Okay, so number 5, I just want to be on the record, that's not a good idea. It will make things worse. And I mean, not just on the supply side of, there won't be an incentive for builders to build homes. People will not want to move, and we'll have the same problem in the rental market we have as in the home buying market. That's not a good move. But, I follow Jason. By the way, Jason Furman is an excellent economist, and I envy the people who get to take EC10 over at Harvard from him these days.
Oh, right. He's a professor at Harvard.
He's a professor at Harvard. That's right. And that course is absolutely fantastic. But the thing is, you know what? The people who follow him wrote back. They disagreed with him. It was the Fed independence that was number 1. I think Jason was taken a little bit aback by that.
Right. Well, I think his premise is that it wouldn't be possible to threaten Fed independence the way Donald Trump seems to want to, but still, you've got to rank them in order of the actual threat. I saw
Liz Truss was at the GOP convention. Yeah, they might want to be thinking about what a head of lettuce means. Right. Because if they were to try to do something like that, we would begin talking about the bond vigilantes, whoever those guys are. By the way, I live in Austin, Texas these days. I've seen one of the guys from ZZ Top, and I'm like, that's what a bond vigilante is.
Sweet. Right? Exactly. That's a great face to put to the bond vigilante.
That's what a bond vigilante looks like. But they will be back quickly, and it will be painful if the GOP attempts to do that or do something more ridiculous, like devalue the dollar, right? Yeah.
So we got the 10-year Treasury at 4.16%.
Yeah.
Where's that going to be year-end, do you think?
Okay, so my year-end target was 4.2 with some downside risk. I still think that's, intact. I think that when the Fed gets to the point where it begins to telegraph it's cutting rates, probably right after the July 31st meeting, you begin to see the front end of the curve begin to move down. Because what we're going to be doing here is, this is a good thing, right? Is we want the price of money to be positive. We want a term premium that's positive on the yield curve, right? We're going to get a disinversion of the yield curve next year. Hey guys, this is what's supposed to happen. This is what financial markets are supposed to look like pre-2000 and pre-GFC, right? Yeah, we're going back to the future, and it's a good thing.
So we will have then we will have had 2 years of inverted yield curve and no real recession.
Well, Matt, as you know, I'm a firm believer in that the yield curves predicted 11 of the last 3 recessions. I dropped that rule of thumb a long time ago. Don't get me wrong, we pay attention to it because it shows stresses and strains across the yield curve. Stresses and strains across financial markets, but it's not the predictor that it might have been, back in the 80s or 90s.
Back when Paul was at Duke.
That's right.
Back when Paul was skipping Cam's courses
to go play golf. So the golf course is right across the street.
How
from the
can you
business
resist?
School. I mean, exactly.
No
World
way.
class good.
Who was your professor? He's
Cam Harvey.
Cam Harvey.
Yeah.
So
Really?
From
Oh, I didn't know that. How cool.
So he's So he's out of the Chicago school guys. So the primary risk, it sounds like, from your perspective, is this Fed holds rates too high, too long.
Too high for too long, and of course, oil. Right? Those are the real 2 big risks. But I don't think that investors or firms have really priced in what friendshoring means, what the relocation of these supply chains means in terms of a permanently altered structure of pricing, both domestically and globally. We're going to have higher inflation. We're going to have higher interest rates. Right, and I do think that's going to be an ongoing issue, again, regardless of who wins the White House.
I want to get your take on the markets quickly. We only have a minute left, but as an economist, what do you think of the fact that Gina Martin Adams has written about the S&P 493, right? The companies that aren't the giant mega cap tech stocks have been in an earnings recession for 6 quarters, and they're finally going to start to post some growth. At least that's the hope. Do you watch earnings season? Oh,
very closely. We actually use the artificial tool on Bloomberg to go through and look at the key earnings that really are important to our firm. Look, no one likes the overconcentration of risk in the Mag 7. Mm-hmm. I'm happy now it's beginning to broaden out. That puts a smile on my face. Although I think that we generally are underestimating the positive productivity shock that artificial intelligence is going to bring to the U.S. and global economy. That too should begin to spill over as we're in the second phase of AI where we're past the euphoria.
Right.
Now, how are we going to use that, right?
Yep. So we'll get to that. That's the next big thing in this market. How do you use AI? Joe Brusuelos, thanks for joining us. Appreciate that. Joe Brusuelos, Chief Economist, RSM, joining us here in studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Looking at the airline business, United Airlines, they said the third quarter profit will fall short of Wall Street's expectations as U.S. carriers slash ticket prices to lure domestic travelers, keeping even the industry's largest players from fully capitalizing on record summer travel. Let's bring in George Ferguson. He does this stuff for a living. He's a senior aerospace, defense, and airlines analyst from Bloomberg Intelligence. George, again, I haven't been on a plane in a long time that wasn't packed to the gills here. If the airlines can't make money now, when can they? What's happening in your industry?
Yeah, so I tell a lot of people, right, you can't confuse airplanes being full with profitability, right? Everything depends on the price paid by those folks flying. Really, the industry is just suffering from overcapacity, right? United confirmed that today. Delta told us the same thing earlier. We saw Alaska results come out today as well. Their load factors down, yields flat, load factors down, telling me they can't fill airplanes at the right price point. We need capacity to come out. Everybody's pointing to an inflection point in 3Q. Today United said that they'd get down to maybe after mid-August, maybe 2-3% growth in capacity. I think that's just still a too high level of capacity growth, right? This isn't an economy that probably year over year grew about 1%. I think that number ought to be tied much closer to GDP growth. You just talked about in the update about unemployment rising, right? So the U.S. economy appears to be slowing a bit. So I think those things are working against the airlines right now. A bunch of capacity has to come out, I think, to get back to pricing power, and that's what's needed to get profitability going.
So how does that happen? I mean, do the airlines themselves pull capacity out? Don't they have competition in this market? Don't we have regulators to ensure that?
Yeah, so how does it happen? We're starting to see some of it happen. Today, Alaska announced that they were going to add more premium seating to their
Can I just
airplanes,
pause
which
here
is-
for a fun fact,
Sure.
George?
Sure.
For
love
a
fun
long
facts.
time, Paul Sweeney thought that the Eskimo on the Alaska Airlines tail was actually a picture of Jerry Garcia.
I did.
Yeah, no, actually, he's told me that. And,
I love it.
I'm not sure what that says about Paul Sweeney. but that's
Exactly.
it.
I mean, what an airline to
Yeah,
put a picture of
exactly.
Jerry Garcia on the tail.
They're so cool.
All right, so sorry, go ahead.
So we're starting to see capacity come out with these announcements like Alaska, where they said, hey, we're going to add more premium seating, which usually means a bit less capacity in the marketplace. Frontier's going to block your middle seat so you can get a premium seat out of Frontier. That obviously brings some capacity out. But what you really need is you need airlines to start parking airplanes. And I think that's hard too, right? So United, Delta, all jazzed up about this inflection point. But look, I would note that there's a lot of very fast-growing, low-cost airlines in the U.S., Frontier, Spirit, even JetBlue, right? They lease a lot of airplanes. You fly airplanes you lease because you got to pay that lease payment no matter what, right? So I think it gets difficult here, and it takes a little while to get capacity out. Maybe next summer, I don't know.
I was talking with the CEO of JSX the other day on my new television program. It's called Bloomberg Open Interest. Tune in weekdays 9 to 11. And they fly fascinating routes. For example, they'll fly from the Westchester Airport to the Naples Airport,
Right?
Or some airport outside of LA into Palm Beach. So are we going to see more of these upstarts, George?
Well, so we always do in the industry, right? So the beautiful thing about this industry is when people sell airplanes, someone buys them cheap and starts flying routes like that. And there's always someone that wants to come to this industry, right? It's got just a heavy allure. Everybody wants to own an airline. That becomes one of the challenges too, I think, in sort of making money in this industry. But the big folks, they'd love to have more maybe the ultra low cost point at those smaller airports, but you just don't get the demand out of those smaller airports, to really fill big airplanes. And so that becomes part of the challenge. I think right now, one of the bigger parts of the challenge is definitely business is we heard United say 100% of what it was in 2019. Obviously that gives you sort of no growth since the pandemic. They're saying the share of revenue in the cabin is lower. That's always at a really nice price point, and business likes to go different places than leisure does, so it diversifies your routes to a certain degree, but you need enough of it to go to those other destinations. So business just isn't back enough, I think, to let the big full service carriers move into maybe some smaller size airplanes, more diversified destinations, and get competition off those sort of heavy volume routes. And I think that's part of the problem too.
And Matt, once a year, George Ferguson goes on this boondoggle with all these other airline people. They go to either Paris one year, and then the next year it's London for these air shows where the big airlines and the aerospace companies buy and sell aircraft.
Yeah, we see Guy Johnson.
Yeah, it's just a total scam. But anyway, George is going next week to Farnborough in England. George, what do you expect there? Are we going to see some big orders? What's Boeing going to do? Do they have to go do like a mea culpa tour in Farnborough?
I think they are. I think they'll be holding customers' hands, talking to them about all their quality changes, how it's going to make a better airplane, and sort of giving them an update on when they're going to get deliveries. I don't see this being a big sales show. It is a sales show, but I don't see sort of Airbus and Boeing walking out the door with bags and bags of orders, if you put them in bags. I just kind of think it's going to be pretty muted because of both those supply chain challenges and U.S. Airlines earnings season showing us that maybe too much capacity in the U.S. We heard Lufthansa warn already. Maybe there's a little too much capacity in Europe. I think people really expected a much harder bounce back from the pandemic. Again, still missing some of that business travel, economy slowing, just not there. So I think it'll be a bit of a muted sales show at the show.
All right, George, thanks so much for joining us. Appreciate it, as always. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence. But always at some those air shows, you see these monster deals. Emirates Airlines buying 57.
It's true,
Airbus,
and they're often a surprise. So
Yep.
Tough to predict. But I feel like both of the members of our airplane making duopoly
Yep.
have already got order backlogs going out years.
Right.
So what difference does it make?
Yeah, what difference does it make? And Boeing's got its problems. I mean, George talks about the builds. They're building like 35, 36 737s a month. That needs to be well north of 40 for them to start getting to some cash flow there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to that internet thing. Go youtube.com. Search Bloomberg Podcast out. Alex Steele's out today. They're telling me Matt Miller's going to be here at an 11 o'clock hour. I will believe it when I see it. Let's talk some real estate here. Commercial real estate, residential real estate. We can do that with David O'Reilly. He's the CEO of Howard Hughes. Howard Hughes is a publicly traded company. Triple HHHH is the ticker in your Bloomberg terminal. That'll bring it up for you. David, thanks very much for being here. And what brings you to New York City other than being that world's financial capital?
Always a pleasure to be here. Thanks for having me. We do have an asset here at the South Street Seaport in the Lower East Side of Manhattan.
Okay.
We're in the middle of filing with the SEC for a spinoff of those assets into its own separately traded company focused on entertainment that will leave Howard Hughes positioned really just entirely focused on building world-class communities that we've been doing since we were
I
formed.
got some stories from me and my gang at South Street Seaport in the late 1980s. We'll just leave it at that. Talk to us about, first of all, Howard Hughes. Where did this company come from, given the name?
So it was spun out from General Growth Properties. Bill Ackman at Pershing Square took control of General Growth, the mall company that went bankrupt 14 years ago. And he found in the mall company were these great communities, the Woodlands outside of Houston, Summerlin outside of Las Vegas, Columbia, Maryland, between DC and Baltimore. He said these companies don't belong in a public mall REIT.
Okay.
They need their own company.
All right, so let's just talk, I'm just looking at what you guys have there. Let's talk about office space. You have 6.8 million square of office space, 6.8 million square feet of office space. I go through any town, USA, any office yard, you're going to see the sign stuck in the grass outside, X number of square feet for rent here. Mm-hmm. What's your portfolio look like in terms of occupancy rates, that kind of thing?
Yeah, our occupancy is trailing up at close to 90% last quarter.
Really?
And it has defied gravity and really defied the national headlines of doom and gloom.
Why is that, do you think?
We, during the pandemic, saw the migration of a lot of really smart, well-educated workers coming from the coast, leaving higher crime, leaving higher taxes, chasing quality of life, chasing affordability. And now we're seeing companies chase those employees. And we're seeing those companies come in from those big cities into places like the Woodlands, where we filled up over the past 2 years almost 750,000 square feet.
Interesting. So where is your office space today versus maybe pre-pandemic in terms of vacant occupancy and rate and that kind of thing?
I would say vacancy is a tick higher. We were about 92% pre-pandemic. Rates are almost identical.
Really?
Yes.
Interesting, because the story in cities like New York City, for example, the story here is if you're in an A office space like Bloomberg's headquarters, you're fine.
Right.
If you're in anything else, good luck.
Tough sledding,
yes,
no doubt. But in a community like the Woodlands, we control the development of all new product. So we're only building to meet supply. There aren't four folks with a shovel in the ground all at the same time rushing to be first and the other three lose. So by controlling the supply side of the equation, we were able to mitigate some of those bigger swings that are typically associated with the office market.
6,000 multifamily units. Where are those units, generally speaking, and how's that business doing?
The business is incredible. We've seen great same-store growth year over year. And a big picture, we have a 3 million plus housing unit shortfall across the country, and multifamily is trying to address some of that, especially from an affordability perspective. Our portfolio in the Woodlands remains high 90s, rents increasing year over year. Same with our portfolio in Columbia and Summerlin outside of Las Vegas.
I love Summerlin. Another great golf course there in Summerlin. All those courses out there. How is Vegas doing generally? Because that's one of those markets up and down. It's kind of the poster child for when things are great, poster child when things are bad. Where are we now in that cycle for Vegas?
Vegas is in a really good spot right now. We're selling over 1,000 homes in Summerlin this year and last year. We hit record home sales. First quarter, we were up 24%. Builders are buying land from us at a record price per acre, and we're kind of the catcher's mitt of all those residents looking for quality of life.
All right, you've got a land bank. I'm not a real estate guy, so I don't know what a land bank is. I'm guessing you guys own 35,000 acres in a land bank.
All right.
What do you do with that stuff? Do you develop it or you sell it?
We play SimCity. We put in the roads, we put in the hospitals,
Okay.
police, fire stations, wastewater treatment plants, and then we grade land and sell it to home builders who build homes. Residents move in. They need commercial amenities, places to shop, office buildings to work. We build those with the cash from selling land to home builders and create these communities like Summerlin. Sometimes we build golf courses.
Right, exactly. The TPC Summerlin, I've lost a lot of golf balls in that desert. What's next? What's the growth for your company here? I'm looking at just on the Bloomberg terminal here. Here's your company, folks. You got a market cap about $3.7 billion. This company's got revenue, about just right around $1 billion. $1.2 billion is a forecast for 2024. EBITDA, which is what I look at, actually you guys are a real estate company, so operating income $300 million. So this is a real size company. It's some heft. You got about $5 billion of debt on your balance sheet. Where's the growth going forward?
It's across all of our communities. Our job is to transform that raw land, that land bank, as you referred to it, into income-producing assets by meeting the demands in our community. And like I said, across our portfolio, our multifamily is very tight, high 90s occupancy. We need to build more. So we're moving very quickly to start that next multifamily project in the Woodlands and the next one in Summerlin to meet the demand that's in that community.
So it's better to stay, I guess your strategy is to take your existing communities, the Woodlands outside of Houston, Summerlin in Vegas, and expand those as opposed to saying I'm going to Phoenix or something.
Well, it's funny you should say that. 2 years ago, we went to Phoenix and bought 37,000 acres in a community called Terra Vallis. We're entitled for 300,000 residents and 55 million square feet of commercial space, roughly the size of St. Louis. We've already under contract and sold over 800 lots to home builders at over $700,000 an acre to meet the housing demand that exists in the West Valley of Phoenix.
So who builds the homes? Do you build the homes or do you go to D.H. Horton or Toll Brothers or one of those guys?
We sell to all the public builders, a lot of large regional private builders as well. We try to be Switzerland, sell land to whoever bids highest and delivers the best product.
What's this interest? We've been in this interest rate environment for the past couple of years of much higher rates. We all grew up, it seems like over the last 15 years with zero interest rates. How's that impacted your business's higher rates for longer?
It's been an accelerant. And it's absolutely contrary to popular opinion, and it's contrary to the headlines that we read every day that higher rates is killing homes, they're less affordable. But really what it's done is it's taken out supply. There's almost no resale out there.
You're right.
So the home builders and new home construction, which is our business, are thriving. We've seen greater demand for those new homes than we have seen in a long time. And if you add in that last month, for the first time in decades, new home pricing was less expensive than resale. New homes have typically traded on average for 20 years 17% premium. Last month they were less expensive.
Interesting.
And it's really pushing a lot of buyers that want that quality of life in our communities to buy new home construction, and that has been an accelerant on our business.
I'll tell you, just D.H. Horton, just today, the stock jumps to a record high as their third quarter earnings beat estimates.
Look, sometimes I'm lucky, not good. I think it was about 6 months ago, I thought that 2024 would be the golden age of home building.
Right.
Rates would start to tick down a little bit so that we'd see more demand in buying homes, but not so much that we'd see resale pick up. And the record margins that public home builders have been printing, 25 to 30%, which to me, I don't remember that in my career, just going to remain strong.
So when you're selling land to a D.H. Horton, you're like, I'm not giving you a break on this land. I just saw your earnings yesterday. You guys are crushing it.
We put them out for bid, and we bid based on a couple of different factors. One is price per acre, but other is our builder price participation. We are expecting a home to sell for, call it $500,000. If it trades for $600,000, I get about 20% of that upside.
Okay.
To make sure, it's a little bit of schmuck insurance, right? If the market rips, I want to make sure I get paid for my dirt appropriately, so we have a little true up at the end when the homes are sold.
Interesting. That's so smart. What do you expect interest rates to do here? I mean, here, this global Wall Street, that's all we talk about, it seems like. You're on the ground actually in the business.
Yeah, look, if I knew for sure, I wouldn't be talking to you. I'd be on a beach somewhere. I do think, rates will start to come down towards the end of the year. I think it'll be a modest decrease. I don't think there'll be anything massive that will shift the tide, so to speak. And I think it'll continue to be good for new home sales, continue to be good for home builders, and continue to be good for the value of our land.
All right, very good. And we'll see. Again, D.H. Horton came up with some big numbers today. So that new housing market remains very strong. And if you've got quality properties like, the Woodlands or, Summerlin, good spot to be. David O'Reilly, thank you for joining us. David O'Reilly, he's the CEO of Howard Hughes, trades on the NASDAQ. The ticker is HHH. It's got a market cap of $3.6 billion, up 1.4% today. We appreciate you coming in.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.